My background is that I started my career at the Bank of England in 1990 and I came into fund management about 3 or 4 years later. So I've always been on the UK equity side of fund management throughout the various cycles. My current role is head of the UK equity team at Columbia Threadneedle, with particular responsibility for the flagship equity income fund in the UK. So as an income fund, obviously a primary criteria is to generate an attractive yield, and we're trying to do that smoothing through the cycle. So where you do have end of cycle big cuts in dividends like we saw last year, you're trying to mitigate as best you can. So it's a through the cycle approach. However, I think it's very important to emphasise that we're not just a one-trick pony. It is not all about the income. We are trying to deliver an attractive risk-adjusted total return over those rolling 3 and 5 years by constructing a portfolio that doesn't look like the index or indeed mimic other income funds that clients have the choice of. So, you know, and that actually last year is a great example, as it was coming out of the financial crisis, that you absolutely do not mechanically sell companies that have reduced or removed the dividends if you feel there is the wherewithal to navigate an operational recovery, because that first flush of recovery capital growth is a key component of your total return if you're trying to be a contrarian investor such as ourselves. I mean, there's no secret sauce. It's you know, it's hard work, and it's a sort of a broad church really. So we've got a strong team, different backgrounds, different investment styles, and I think the fusion of that and the debate really is where there's value add. And so we're trying to look at a business from a different perspective to the wider market. We're trying to figure out how the business would look in a few years' time, in a few snooker shots, if you like, rather than just where is the next earnings print's going to be. You know, we're not going to compete with the fast money who are trying to, you know, pinch pennies in front of the roller. You know, we're trying to think a few years ahead and be patient investors. It's very much the team drives the ideas, both offense of potential new ideas and defense of keeping on top of existing positions, and to make sure that, you know, they're on track with the original investment thesis. But we're not proud. You know, we're very much open to external ideas from the sell side, etc. And obviously, when you're engaging with managements of companies, that might provoke thought about sort of some of their supply chain or maybe their competitors. So we're always trying to think active, act lazy, if you like, that, you know, an investment decision won't come at us just in a flash. It will have been iterated over a long period. We'll have met management several times, etc. So it's, you know, that's important. There's a lot going on underneath the water, even if it's reasonably serene and relatively low turnover portfolio. Well, the challenge and the hope is that by being underexposed to the most sort of crowded, popular areas of the market, that when the music stops and there is a big drawdown in markets, that we should deliver a good shock-absorbing sort of return relative to a weak market. So we should do well in drawdown markets, and fingers crossed, you know, that's something I have achieved over my career. And last year, the flash crash, as it's been known post the event, was very unusual in that a lot of more contrarian orientated funds initially struggled because you just didn't have that rotation in the market that you would normally have, like you did in 12 on the Euro crisis, or in 08, the financial crisis, or indeed 2000, the tech bubble finishing. So I was very pleased and proud that the fund, we were able to keep out of trouble relative to some other funds. So that was quite a test really, and hopefully endorses the balance and the portfolio construction as much as the stock picking ability of the fund and the team.